Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Amir Baluch. How you doing, Amir?
Doing all right. How's it going?
Doing well, doing well. Well, glad to have you in the show here. For those listeners who don't know you, tell us a bit about your background before we begin.
Yeah, so I'm in Dallas, Texas. I'm a semi-retired anesthesiologist, but it wasn't always this way. I came to Dallas in 2010 after finishing my anesthesia residency in Miami, and within a year I got my real estate license, started a brokerage, and got my securities license, and joined a boutique investment bank. And I was there for about half a decade. We went through almost $1 billion worth of transactions in multifamily, hard money lending, and private equity. And sometime around 2016, I left to go off on my own and create Baluch Capital, which is a multi-asset platform for alternative investments for accredited investors. I pulled my brother out of there, and he runs the real estate side now in our single family real estate development. I'm running point on private equity, mainly in life sciences. And we also put together asset-backed debt funds for people looking for income. And we're always exploring other ways where there's some arbitrage or some inefficiencies in the market, so we could get some alpha in our investments.
So let me get this straight. So you're doing basically investment banking or fund management, and you're a doctor at the same time?
Correct. But I'm only working about 4 days a month these days.
Being a doctor?
Right, right.
Okay. So why do both? What kind of drew you to want to do both? It's not, I mean, anesthesiologists make enough money, so why do both of that?
Well, the reason I got involved into personal finance and finance in general is because back in the year 2000, when I applied to med school, I didn't get in. So I didn't feel like I could trust just one source of income or one path. And I tried business. I lost my life savings at the age of 21, which is not that much. It was like maybe 40 grand. But so that didn't work. So I moved in back with my parents, and my dad, who was a doctor, ended up having to declare bankruptcy for mismanaging some funds and things like that. So in my mind, I just never relied on one source of income. And anesthesia is fine. The goal wasn't really to get out of anesthesia, but it's not very scalable. And these other businesses and funds were requiring more attention. So I had to make a decision. And in fact, about a year and a half ago, I quit completely just to see what it would be like. And I was actually even getting depressed. I was just sitting in front of my laptop all day long. Like I really felt like I was depressed. I needed to have some type of social social life. So, and actually, the hospital was that for me. So, it's kind of fun to get free food and show up in your pajamas and listen to music while the patient's asleep. So, that's why I like to do that at least 4 times, 5 times a month.
Nice. Nice. That's cool. So yeah, so tell me, it sounds like you're doing lots of different stuff. I mean, you're doing investment banking, you're doing deals. Like what areas are most interesting to you right now?
So, there's a lot of interesting things going on. So the because of my background in medicine, I personally am more interested in anything life sciences or biotech related because I see how it's helping people with their health, which is why I wanted to be a doctor in the first place. So for example, we have a cancer test right now. They could one blood draw done at your house will screen for 200 cancers instead of just getting one invasive test or some imaging for one cancer at a time. So to me, that type of stuff is really exciting. Just new technologies making things safer and more efficient and preventing disease. I kind of like that space. But there's some new spaces too that people don't even think about. For example, we'll be launching a life settlements fund, a second one, where you could buy somebody's life insurance policy. Let's say if you had a life insurance policy for $1 million, you've been paying premiums all your life and you really don't need it. And maybe you don't want to pay the premiums anymore, and so it's gonna expire worthless, which happens, by the way, 97% of the time. People don't know that. So insurance companies make a ton of money. So imagine I could go to you and say, hey, I'll give you 150 grand, but make me the beneficiary. I'll take over your premiums. If you end up dying within 5 or 7 years, I'm making $1 million with 150K. And so there's usually some good return there with very little risk because eventually everybody dies. So it's something where you could get good returns and pretty low risk of losing money since eventually all people have to die. So there's interesting little niches like that. We've looked into litigation finance too, just haven't been able to put something together. Just funding attorneys where they have a certain win rate and uh, we get a percentage of that. So those have been just some examples of alternative investment classes that most people are not aware of.
Well, I mean, it sounds like you do everything. You're saying you like life science and biotech, but now you're doing legal settlements and life settlements. I mean, those are very different fields. So how do you pick and choose?
Well, one thing you just mentioned was very important. They're very different fields. And so when they're very different, that means that these investments are not correlated to each other. And if you have a portfolio of investments that are not correlated to each other, that's actually the definition of true diversity. Versus if all your money's in the stock market, okay, it's spread out over 50 companies. That might seem like you're diversified, but you're actually still all in the stock market. So when the stock market goes down, like it recently has, pretty much all the companies are down, even ones that have some good fundamentals. So because all these other asset classes, they go up and down or perform based off of different variables, that's what reduces your risk. And if you reduce your risk in your portfolio, your reward to risk ratio goes higher than the average investor. And that basically that's the definition of a good portfolio, right? You want to have good returns for the risk that you're taking. So that's why we're in multiple ones. And it's not just me. I don't want people to think, hey, I'm here running everything. Like my brother really runs a lot of the real estate development. We have partners for example, our Indian trading hedge fund. I'm a co-manager on the life settlements uh, team, where there's 5 people on that team, including the largest broker of life settlements in the nation. So there's teams of people that divide the task uh, to make these funds run. It's not just a one-man show.
Okay, all right. So you have teams that do this because and I assume if you have are the funds aggregated or are they all independent funds?
So they're all independent, but they're all structured differently. So,
Okay.
for example, on the real estate side, you can invest in one deal at a time, or we'll have a blended income fund where you could get double-digit pref paid quarterly or monthly, and that's going to be spread out over multiple deals.
Okay. So I'm curious, we'll get into a lot of these areas. I'm curious about life settlements because I've talked to a lot of people and that's a very tricky business now and a lot of funds are not getting great returns. So, how are you able to get reasonable returns in this environment? Because most of the ones I've talked to, they're losing money because they miscalculate. People live longer than expected, and all these other things that happen. And I assume that's going to continue to happen. People continue to live longer, and so it's not. I remember looking into this about 20 years ago, and it was interesting, but it was starting to get the margins were starting to get squeezed back then because there were some big players coming in and buying them all up and squeezing out the margins. So how are you able to make that work?
Yeah, so a couple different ways. One is at the top of any funnel, you need to be able to get as many deals to look at as possible, right? So if let's say if you only have 10 deals to invest in and you have X amount of money, I mean, you need to close on some of those 10. You might not be able to cherry pick, but if we have hundreds of policies that we're looking at to buy, we can cherry pick and stay with the top 5% that will work with us. And we also, when we put into our calculations, we say, hey, what if their life expectancy is this? If they live twice as long, can we still get a 12% return in the fund? If the answer is yes, we'll buy the policy. Another thing too, the fund is underwritten to an IRR of 22%. So let's say if we buy something and it should perform at 22, but let's say somebody lives an extra year and we don't like it, we can actually sell in bulk those policies down the road to some exit buyers that underwrite to a 12. So already if we're buying at a 22, uh, but somebody's willing to buy it at a 12, we literally could just flip that policy if we think it might underperform. So there's a couple ways where you could hedge yourself um, in those positions. And even sometimes adding some leverage, you could even reduce your risk with leverage depending on the price, because you might want to double down or put more money into policies that are more bought at even a lower cost, right? Versus ones that may be 20% below market price.
Yeah, that makes sense. I'm curious, why wouldn't you just, I mean, if you're getting that big of a spread, why wouldn't you just, sell them quickly, make your 10% move on? You don't have to sit on all that capital.
Well, you can make higher returns if you keep it longer and perform.
Okay.
That's the main thing. It's more like a backup plan. And also you have to aggregate these things too. So, the big buyers that want lower returns, they want to buy in bulk. So you might have to put together maybe 5 or 10 policies and sell it in bulk in one time.
Okay. Cool. Um, Now, what about litigation finance? Because I know with that's kind of a crazy field that there's big swings with those, and it's really hard to handicap. So, how do you handle that space?
Well, so we're just now looking into it. We haven't pulled the trigger on anything ourselves. And, we want to know what type of markets we want to go into. There are some people that are doing thousands of these and maybe doing large settlements of some type, maybe in the millions, but there's another market, like a smaller market where maybe these settlements are 200,000, 500,000, but might be easier to win. So we're in the data acquisition process of that to see how do we want to enter the market? Do we want to go all in with one company and do an SPV, or do we want to set up maybe something like a funds of funds structure and work with 3 other people that are already doing this? So we haven't sorted out exactly how we want to enter the market, but we just know that it's not correlated with a lot of other things that we're doing, and that's why it's attractive to us.
Okay, cool. Um, so what do you do in the biotech and life science space? I mean, you doing private equity, or what's the how do you get involved?
Yeah, so my main interest was in early stage back in maybe 2016, 2018. So that's more in the venture capital early stage. But now we're also getting interested in leverage buyouts, but that requires a lot more capital. So, but we could partner up with some people in the leverage buyout space. It's just not that easy to do, to find something that's very attractive, but that could be immediate cash flow. That's unlike the venture capital. So the biggest complaint I get from venture capital is, hey, where's the liquidity? Hey, where's my monthly check? So if you're an early stage investor, you're going to wait a long time for that, right? And people have to understand it. And I think a lot of people don't. But in the late stage, if there's already some cash flow, we could roll in there. So for example, there's something on the table we're looking at where we could roll up some behavioral science centers. There's some centers that work with, for example, autistic kids. So uh, people don't really know too much about it, and we can get good prices on those companies now. And people pretty much know the game. You roll it up and you sell a big pile of them to the next person. They just pay, double the price that you paid. So that would be the strategy there. For the life sciences and as far as the sectors go, I'm not too much into the pharma, into the drugs, because it's a little bit more risky. But I do like things like med tech, which it's a little bit easier to get FDA approval to get things passed. And we do like medical SaaS also. Software can solve a lot of everyday problems and it can scale really quickly. And usually the overhead to maintain it is not that much. You're not dealing with a bunch of employees because the software doesn't eat or sleep, right? So those are kind of the spaces I like to look at.
Nice. Well, that obviously brings in the concept of AI, which is becoming a big deal lately. How is that impacting, you know, in the spaces you're dealing with, whether it's medical or real estate or what have you?
Well, it's kind of the wild, wild west. So everybody knows it's disruptive, but at the same time, almost everybody has access to it. So imagine if we gave everybody a machine gun and we're going to war. I mean, everybody just kind of have the same tools. So it's going to be about how are you using those tools and how fast can you use them. So I think the people that are going to win are people that can move very fast. So like the velocity of how fast you can implement the AI, and also the quality of your prompt engineers. So, everybody has access to ChatGPT, but the output you get depends on the quality of your prompts and also the quality of the data that you feed it. So in the future, velocity and data are going to mean a lot more than the actual AI. And so a lot of the companies we have, if they are using something with AI, we don't stop there. We want to know, hey, what is some other type of barrier to entry that's protecting what you're doing from some other competitor? It could even be me. Maybe I want to get into this space tomorrow and I'm going to build software with AI. Now I'm a software developer tomorrow. And so, luckily we have those answers for some of the people because especially in healthcare, I mean, I could give software to somebody. It doesn't mean that they're going to have the relationships to get into the hospitals or know how to integrate their software with the APIs for the electronic medical records, something like that. So that's kind of what we look like on the defensive side. Hey, does this make sense or not? Or can anybody come in and do it? Otherwise, everybody's going faster and faster. And, you know, that's at least for the biotech side. We've seen some of that. On the real estate side, there are some software out there. We've actually, had our friends use it. We didn't actually pay for the subscription, but there are ways where you're like, hey, what makes sense for build to rent communities, which is what we do. So they'll look at a ratio of the rent to the purchase price of the property for us. And then they also are looking at the trends of the rent. So if it looks like the rental trends are high and the ratio of the monthly rent to the purchase price is above, let's say 0.75 or 0.8 percent, then that means we should probably build there for a build to rent community. So, and then non-investment side, you guys already know if you've gone to any websites recently, conversation with customer service is pretty much, sometimes it's even more fun talking to an AI bot. They're so good and they're so calm about everything. So sometimes I even prefer talking to some of these AI bots these days. But the communication is immediate. So imagine for property management, uh, how helpful that is for property management on the communication side on the front lines. And for our trading fund in India, for example, we've used AI to back test and forward test a lot more quickly, and even creating special algorithms and just constantly feeding it data and what if scenarios. What if this happens? What if this happens? And doing almost like a role play, and that's helped decrease our risk more than increase. It hasn't shown us to increase our returns as much as it has shown us to decrease our risk. So we're taking maybe less trades, but the trades that we do take are not necessarily more profitable. It's just we're taking less bad trades and best and better positions. So that's how we're using the AI.
Okay. Yeah, I'm just curious where you see the opportunities because I go back and forth in this. I think it's way overplayed at this point for most areas, and I've been wondering right along, and starting to hear corporate CEOs talk about the same thing. It's nice as a hobby tool to go play around with and ask it. I mean, you create a purple cat for me, but when you want to have it be a really expense saving functional piece of technology, it's not quite there yet, and it might get there, but it to me it seems like people haven't figured out how to use it, other than just like ask it silly questions. And I know it does coding, and in the medical space, I've heard it. Actually, let me give you an example. Like I use this. I used one of them a while ago to look at medical tests and blood work and stuff like that, and it was like, give me a diagnosis. It was really good. I have to say it was better than my doctor. So, which probably isn't surprising nowadays. But
Mhm.
I look at that and say there's some really good uses for it, but I haven't seen them rolled out to the public. And then the next question as a follow-up is, what's to stop if I create something you from creating the same thing? Like there's no barriers to entry like there is with most things.
Right.
So,
So on your first question, a lot of Fortune 500 companies have rolled out AI, and the ROI on all the research and development into it is maybe 5%. So they're not getting this massive ROI bump, but everybody's pretty much going to be forced to use it because if not, you're going to be left behind because it will increase the revenue per employee, which is a key KPI in a lot of large businesses. So if your competitor is using it and now they're more productive, if you don't use it, you will be left in the dust. So using AI may not give you the edge. It might just make sure you're not left in the dust. Then also AI is just one part of a workflow automation. So we're going to have a new era where there are people that are experts in workflow automation and business automation, where they look at your whole process. What do you do every second of the day, every second of the week? What can be automated to free up some time for you so you could focus on what you do best or do an 80-20 with everything that you do during the week? Spend more time on that 20% that's responsible for 80% of the results and try to automate the rest of that stuff to free up your plate. So we're going to see AI uh, go into that position where it's just one part of workflow automation. Uh, on the second, what was the second question? What's stopping just somebody else from jumping in?
Yeah, I mean, there's no barriers to entry with this stuff.
Yeah, for the most part, there's not as far as using ChatGPT or, people want to use Manus. They can do that too, which is at the agentic AI. So eventually, people like me and you will be walking around with our cell phone in our back pocket, but on our cell phone, we might have 50 or 100 agentic bots that are like mini employees and mini VAs doing work for us quickly. So that's not going to stop. So people can jump in, but now who's making the best decisions with those AI bots and with the AI in general? Who's creating the best workflow automations and who has the best data to create the best output? So it's going to become a data play and a creative play and a problem solving play. So those are the people that are going to excel, and people that just have access, like the access to the AI uh, is not the game changing thing anymore. It's going to be how are you using it and what data are you feeding it?
So have you seen anyone using it successfully right now that's killing it? Like using it to find great real estate deals, or I mean, real estate's one of those areas that's just it's the inefficiencies is what allows you to find good deals, right? Because you can go to the stock market and there's no inefficiencies. I mean, you could argue whether it's priced correctly or not, but it's not inefficient, right? It's like penny difference in the spreads.
Right.
When you got real estate, you got wide spreads, it's inefficient information, and that's what makes it valuable. But as soon as you start to squeeze all the spreads out, you can't find deals, and then what's the value in doing it? So um, I guess have you seen anyone use it successfully in different areas in that way?
So let's break down real estate to a couple things. There's acquisition, there's financing, and there's ops. So on the acquisition side, which is what you're relating to, it can maybe help narrow down where you want to search, right? So that's kind of, and it can do some number crunching for you quickly. So, for example, if you have 100 deals to look at, you could maybe download the data and plug it into AI and said, hey, make the models for 100 of these deals, rank it from 1 to 100 based off of IRR and risk and define what risk is. So on the acquisition side, you could see it doing that, but so it's going to help you make better decisions there. It's not going to get the property for you, which is the other side of acquisitions. In real estate, a lot of it's about relationships. So, for example, we have lenders giving us a deal before it's even an opportunity on the market. Like they're like, "Hey, this person, I lent him some money. He's taking a long time. Amir, why don't you take this thing over?" Or people are coming to us to partner with us because we can bring in the money and they already have the deal. Okay, somebody's got AI, they're not going to get that deal. I'm going to get it, right? So it's not going to replace the relationships. Now let's go to ops. If there's property management, we already talked about that communication with tenants or anything. So it can help with ops there. I do real estate development, so how does it help with ops? We usually use a Gantt chart where, when we have got, okay, let's pour in the concrete. Okay, once concrete is done, okay, here come the framers, and it kind of goes in a timeline from left to right. and people are kind of handing off the baton to the next person. So we've used automations with a whiff of AI. It's not doing that much, but eventually AI can maybe start predicting when you might have some timeline lags in your process for building a home. So maybe a home that might take 8 months to build, maybe we could do it in 6 if we could squeeze out some inefficiencies with communication and timing of placing orders for the next materials, things like that. So eventually that will be coming to help with ops.
Okay, cool. Yeah, I'm interested to see where it goes. Um, all right. Well, as we kind of wrap it up here in the interest of time, what are some kind of final thoughts you can leave our listeners with? You think that are really important in this new age where all the opportunities potentially could be?
We know things are moving really fast, crazy fast. And I think that means that's even more important to diversify because that means industries are going to be changing fast. Something that might be a good asset class now might not be tomorrow. So the importance of diversifying into non-correlated assets, assets that are not affected by the same variables, is going to become more important to just de-risk your portfolio. And then since we mentioned AI, if you're not using AI, try to use it at least every day just so you're not left behind and try to push it to the limit. See where it could solve just some everyday problems just so you can become familiar with it. I mean, just imagine like the internet when it first came out, maybe people just started using it for research, but now we use it for everything. Same thing for AI. Hey, you're making some images here or there, it's doing some research, it's making some content. It's all in the generative phase. But eventually we're going to the agentic bots phase and we could solve some bigger problems. So just get used to using it every day so you're not left behind uh, as a user.
Nice. I appreciate you sharing that, Amir. Where can people find more about you?
Well, if you want to reach out, you can find me on LinkedIn. I think I'm the only Amir Baluch on LinkedIn, at least the only one that's in Texas. I think also somewhere on here we'll have a link where if you want to reach out to me for a one-on-one or if you want to get a copy of one of my books, we can send that one off for free, just cover the shipping. So there's some ways you could learn more about me, reach out one-on-one or send me a message on LinkedIn.
Awesome. Well, thanks, Amir. Appreciate you coming to the show and sharing your wisdom with us.
Yeah, thanks for having me.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
All right, that was a great interview with Amir. Really appreciate him coming to the show. Now we're into the panel portion of the show. We have our very own Diana Perkins. Hey, Diana.
Kirk.
Glad to have you on the show. You're our first time panelist and longtime guest. Appreciate you coming to the show. It's summertime, so we are we're panel light today, but I think Diana will carry the weight of our other two missing panelists. So yeah, let's just dive right in. So Diana, what were some of your thoughts from the interview?
So first of all, I really enjoyed the interview. I think alternative investments is such a hot space and there's rising interest in that area. So maybe we can dig into that a little bit. But first and foremost, what struck me the most is Amir's background as an anesthesiologist who found his way into a really unique niche area of alternative investments. So I love a story where you have someone who doesn't have that traditional finance background, but there's something that occurred early in their life that led them down a path to leverage that industry expertise into something totally unique, entrepreneurial, especially in the alt space, which can be a more complex area of finance. The other area that I really appreciated him bringing up, which of course is something naturally that comes up with alternative investments, is the diversification of alts across other asset classes like stocks and bonds. And it made me think about my prior life. I worked in management consulting, and I remember, and this was a couple years ago, as part of our wealth management practice, we were talking about this shift from a traditional asset allocation model with stocks and bonds, say 60-40, depending on your time frame risk tolerance, but just stocks and bonds versus something like a 50-30-20 split with stocks, bonds, and alternatives. And so I thought it was really interesting as he talked about his unique space in the backdrop of the broader picture where there's rising interest of everyday people who want to get involved in the alternative space, but they might not be high net worth.
Yeah, it's interesting. I mean, we do a lot in the alternative space, and so I love talking about this topic because it's so misunderstood in so many different ways, right? I mean, we our industry is traditionally evolves around stocks, bonds, and mutual funds, or anything that brokerage firms can make money off of. And outside the market alternatives are not really their bailiwick because they can't make a buck off of it. Um, but they've found ways, and many times, to make a buck off it, so then it finds its way into the retail investors through some sort of fund, a hedge fund, private equity fund, venture capital fund, or whatever. Um, and that seems to be the pathway. And now everyone's talking about private credit, which anytime the retail public gets a whiff of it, is probably too late to get in my experience. But it's interesting. So which alternatives do you find most interesting, Diana?
Well, I mean, real estate's a big one. I mean, that's an area personally. I mean, I'm a lifetime renter. So personally, I don't have a lot of experience in it, but my brother-in-law, he actually has a private equity firm that invests in multifamily real estate. So it made me think about what Amir was saying about finding these areas that are sort of unexplored, and really niche, and exploiting those areas and buying those that are undervalued and then turning them around. Like one of the areas he talked about was behavioral science centers for autistic children, right? So it was like so unique. And my brother-in-law does something similar where he looks for properties in the Midwest, probably not the most explored area, but an area that he knows well, has relationships, and does really well around that. So I think there's a lot of opportunity in real estate as investment properties. And also, just like you were saying, everyday people who want to get into alternatives, REITs, as an example, like there are ETFs that you can invest in that gives you some exposure to the real estate markets as well. So I think that's a heavy hitter. I mean, tokenization is really big right now. You can buy, fractional ownership of art pieces is another one. private credit. I have family members asking me about that. Hey, should we get into this? Which, of course, it's me. I talk about all the risks involved, but that's, yeah, definitely a hot area. So yeah, so many different areas, and I think that's what makes it so interesting.
Yeah, it's real estate's an interesting one because when people think real estate, you're not thinking it as an alternative strategy, right? It's real estate. Everyone's got real estate. Everyone's got a home. You know, I'm a renter too. We've been renting since COVID. We left the city and it's I'm waiting for price to go down. Maybe that'll never happen, but when you and I are from Boston, so we get the same problem. Um but I don't think of real estate as an alternative. Like it's an alternative in the sense that well, if you have an IRA and you're putting it all in mutual funds, yeah, it's an alternative. So most people don't realize you can put retirement accounts into non-traditional assets. So I don't like the word alternative because it's like, what's really an alternative? I mean, if somebody's a real estate investor, then stocks are alternative. Um, but non-traditional, there's like the traditional stocks, bonds, and mutual funds or securities. And then there's the non-securities or non-traditional, which is more anything else. Um, if I use non-securities, people would scratch their head. So I just use non-traditional. But generally speaking, I mean, real estate's still pretty plain vanilla. Um, and it's good, right? Maybe not in Boston, but in other parts of the country, it can be profitable. Um, but outside of real estate, like what other areas? I mean, you do options, so you're already in the alternative space. You're in the you're outside the norm. So what other outside of real estate, like other areas that you find interesting, or maybe you haven't looked at any? I don't know. I don't know how far down the rabbit hole you've been.
Mhm. Yeah, well, so one point I want to make. So, right, so options, right, derivatives considered alternatives. I think in my mind, I think of alternatives as like almost like non-financial assets, right? And so that's why real estate came to mind because it's different, right? It's the liquidity is a lot lower. The barrier to entry outside of, REITs, for, like you're talking about buying a home in Boston, it's much higher. And the correlation with other financial assets, tends to be less correlated. So when I think of alternatives, I think of an asset that is not highly correlated with financial assets that you would think of in a traditional portfolio. I think for me, what I like about, so real estate aside, so I think what I like about maybe just the idea of alternatives is that it can be anything from these, behavioral science health centers to these, insurance policies where you're betting that someone dies during the term of their term life insurance policy because you own it and you're paying the premiums to, I mean, we talked about the private credit to, I mean, this piece of art behind me, owning a piece of that or a Persian rug and just it's just limitless. So that's kind of where my mind goes when I think of alternatives.
Yeah, it's interesting you said art. We actually had a guest on recently. It's not live yet, but and he talked about artwork and being able to invest in art. And I know it's kind of this weird thing that most people don't understand, and even experts don't understand. My dad used to like wine, and he used to collect wine back before people collected wine. Like he was over in France and Germany and all these places collecting really nice wines before it was a thing. When you could get it for like $1 a bottle or something cheap, like really nice bottles, but like just it wasn't the capitalist commodity it is today. And he always had some great insights. He's like, all these people, they have absolutely, even some of the people who think they know a lot, he's like, they really don't. Like they're just they put on a good show for you and make it seem like it's a big deal, but they really couldn't tell a good wine from a bad wine. They've done tests in the last 20 years where they've like tested experts and they can't tell. But this is back before that. Like when people, he's like, you could just spot him. Like that guy's a phony. That guy's a phony. But I think there's an element of that in any sort of art, and I would, I guess, put fine wine in there in the art category, even though it's not. But it's when you're relying upon things that are not dollars and cents, you're relying on people's opinions. It's a little bit more flexible, right? As an investment. And, somebody might like to buy $1,000 bottle of wine because it's $1,000. I mean, who's the guy who paid $1 million to buy a blank canvas with a banana duct tape to it? I mean, come on, really? You have to replace the banana every day? Like, like how does that work? But the fact that he paid $1 million is he want to be famous for paying $1 million. Some people want to do that. So I think it's always an interesting space. I mean, the artwork thing, I don't I don't really have a sense of art, so I'm not a good person for that. But I know things when I like them, but I don't think I could pick out a Monet from a Manet. And but I think the interesting thing is there's um, the market building around it. I think it's a good idea that it's there. I think the challenging part is that it's a lot harder to handicap. It's a lot harder to value. Um, because it's I don't know, the market's just different, and people value the high end stuff, like the really high end stuff, like that keeps moving. The mid range, the low end, I'm not sure if it does. So it's kind of a weird market. I don't know. I mean, you got a nice painting behind you. How much are you into art, Diana?
This is actually my sister's painting, but she
Oh,
was just
cool.
at the puzzle. I got this one for free before she got semi-famous. But yeah, you bring up a really good point. Like with wine, art, there's this other layer of risk in alternatives where when you do get into these niche areas or areas that are subject to more subjectivity, we'll say, especially when you have a finance brain, it's not black and white, like when you look at financial assets. And so I think the key there is to really know that space well. Now, the example that you just gave with wine, I think that might be even like a little bit of a flex. I think art could be too, if you have the money to invest in those $1,000, bottles of wine or $1 million blank canvas with a banana taped to it. Yeah, which is interesting. So I feel like there is this extra layer of risk, of ambiguity. And so with Amir, with him leveraging, hey, I know this industry really well. So I'm going to take that and I'm going to find different unique areas that are tangential or related and find ways that where I can identify, hey, this is undervalued in the market because other people aren't looking at it. And then I'm going to turn it around. And if it becomes, a little too risky, then okay, I'm going to offload it in the secondary market. And to me, that's interesting. I mean, he does have that industry know-how, which I think is essential when you get into these alts areas. But then I think the risk is, he's out there, underwriting these insurance policies. And so, I think, well, what do his models look like? How does he compete with these multi-billion-dollar insurance companies in this space? I mean, yes, real estate, it'll diversify your investment portfolio if you're mostly invested in stocks and bonds, but what about the liquidity piece of that? So I think there's this whole other layer of consideration, risk, potential ambiguity, which makes it interesting, but maybe something you might want to dabble in if you have the means to.
Yeah, you mentioned the liquidity premium, which I think is really interesting. I don't think a lot of people really truly understand the liquidity premium. Could you explain that a little bit, Diana? Because I know you deal with options, and those are standardized contracts, so you can pretty much one is the same as the next one. But like, how does that work? Like, is it worth liquidity premium, or maybe touch on that a little bit?
Yeah, I think it depends on your time frame as an investor and when you need access to the funds that you're using to invest. So if you know that you have, you're going to buy a piece of property or your kids are going to college or you have a large expense coming up in the near term, even though you might be able to get better returns on, say, a piece of a real estate investment or part of this real estate fund, how soon are you going to make that investment back? One of the examples that was given in the interview was around, venture capital, and how soon are they going to get their money back if they're investing in a startup versus, an LBO and getting into something like that. So to me, when you're considering that, that premium around liquidity, it's really the time frame and how long you can have, afford to have your money tied up into an asset that is more liquid, like real estate. And even in options, like you mentioned with options, I mean, I've definitely been caught. I'm a little stubborn sometimes, especially in the beginning when there's an options contract I want to get into and the open interest isn't there, the volume isn't there, but I really want it. I feel the price is right and I might get in, but I have a hard time unraveling it, right? And so definitely when we talk about options and derivatives as well, that liquidity piece. And, I look at stocks over a certain volume that trade every day before I even consider trading an options contract on it because I want to know that I can get out of it when I need to get out of it.
Yeah, I've definitely made that mistake before as well. With with options, it's just like, oh, I got to get into this thing. It looks so good, and then there's a huge spread on it, and it's just like, oh, this is gonna hurt. This is gonna hurt if I have to get out of this if I'm wrong, and that's always a bad entry point when you know that. Um, but yeah, I mean, I think that one of the takeaways that people should consider is when you're investing with stocks, you have uh, pretty clear transparency about what you're getting. Now, could they defraud you? Absolutely, they could. And that's happened, and it'll happen again. Um, but you've got a lot of people looking through the documents, and it's got to be a lot harder to find than maybe a private investment where you're the one that has to do all the due diligence. There's no one else looking at it. It's you and this other person as to whether it's a good deal. I can tell you from experience that most people are picking deals based on relationships. They're not picking it on, well, is this a good deal? They're saying, well, I know this other person. I know they're an upright person. They're not going to steal from me, or I've done deals with them in the past and they've been fine. That's how a lot of investments happen. And which means it's hard to get into the club. Once you're in, it's easy to stay. It was hard to get in. The second part is, um, that's how Bernie Madoff happened, because everyone knew him. He was in the club, and no one thought to look, a second time, and except for a few people, and they were laughed out of the room. But the reality is they were the correct ones because they were actually doing the work. So I think the hard part about the alternative space is the illiquidity. If you're wrong, you just can't get out. Let's say you invest and you're all happy, and then like a month later, a news article comes out, and you're like, wait a minute, that's not what he told me. And you do some research, you're like, oh crap, now you can't get your money out. So in a public stock, you can be out in a flash, but in private markets, you can't. So I think the challenge is you have to take the Warren Buffett approach of be really, really sure going in so that you're not looking to get out, right? If you needed to, you can, but if in the public side, but you need to do your research, quite a bit before you jump in. So, um, go ahead, Diana.
Yeah, I was going to say, I think the housing crisis back in 2008 is an example of that, where you do need to have some level of discernment, financial acumen to make those decisions when it's not what I'll call mainstream. And then the other thing that I'll mention is I love that you brought up Warren Buffett, and he and I have different approaches, which I know doesn't bode well for me to talk about that, right? He's a longer term value investor, but I'm going to quote him or paraphrase his quote. One of the things he said, although I think this may have been about cryptocurrencies and maybe not alts, but he said, it's hard enough to make money on assets that you understand, right? You understand how they work, how they're valued, etc. So, saying, hey, maybe I invest over here, whether maybe there is an area of alts that you really understand. Maybe it is the real estate or the private credit or these behavioral health center, whatever it is. Um, but it's hard enough to make money in the areas that I understand. So why go over here? And so I thought that was really interesting. Because if you're not starting from a level like our guest was, where he's like, hey, I'm, anesthesiologist. I have that credibility in this space. I have knowledge in this space, and I'm going to translate it in a way to be profitable and generate, alpha, as he says. So So I thought that was, that's interesting too, and pretty fitting.
Yeah, I think the way I think about it is the grass is always greener. We have a lot of people come to us and they're like, "Oh, I want to get out of the markets. I don't trust them. I want to get into alts." I'm like, okay, uh, you gonna trust them more? I guess if it's a rental property that you know, sure. I mean, you can touch it, you can feel it, go to the registry of deeds, see who owns it. There's a lot of things you can do. I mean, that's one of the appealing things about real estate because as outmatched as you might be in most markets, real estate is relatively straightforward and simple. You can go, you know where the house is. You can go to the registry of deeds, see who owns it, and decide you're buying from the actual person who owns it. You know what the numbers are. You know what the rents are. Like you know a lot. Now, could you be surprised? Yeah, you could be surprised. There could be a toxic waste dump in the backyard you don't know about. Like there's always surprises. But in general, what's going to happen is you're going to be able to make good decisions relatively quickly in comparison to other things. Now, when you start to add layers, like there's this piece of real estate, and you add a layer. There's a fund, or there's an LLC that owns the real estate. Okay, well that's another layer. Well, what's the LLC own? What does it own besides the real estate? Well, the LLC, let's say it's owned by a fund, right? And then it's owned by this. And you get all these layers that are put on top of it. Now you're just adding complexity. It's not bad necessarily. It's just complexity that you have to sift through. So if you own a piece of real estate that is owned by an LLC, that's owned by a fund, that's owned by another thing, that's owned by another thing, now you're just adding different things. Which one of these things has a problem in it, right? You have to sift through it, right? As opposed to just, I like this piece of real estate. Why do you need all these other things, right? So I think about alternatives as they can be really good or they can be really bad. And what tends to happen is um, if you're looking to sell in a seller's market, you're going to do great. But if you're going to sell in a buyer's market, good luck. There were a lot of people looking to sell in early 2009. A lot of those non-traded REITs were trading for like 5 cents, 10 cents in the dollar. People were just screaming to get out. I remember I found an exchange where you could go buy these things for 5 cents in the dollar because people just wanted out. And I'm thinking to myself, like, well, you lost 95% of your money. You're really that desperate to get out? Like, it's all gone. No, it wasn't, but temporarily it was because no one was buying. Um, and we had just started our firm, so we weren't in a position to go, you know, go belly up into the bar and just buy it all. But that was a great opportunity. And in hindsight, I wish I took it because 7% yields, 95 or 5 cents in the dollar. I mean, that's a great return. And I wish I had more money and I didn't. But you get those opportunities once in a while, and if you're not ready, then you miss out, and it could be a long time before you see the next one. So it's always good to have cash around.
Yes, and I love this example because so you know that the traditional speak is buy low, sell high. And in this example, 95% of the value is gone, selling about as low as you can. And it makes me think about so for those who are options traders, one of the options strategies I love is vertical spreads, and I hold them to expiration. Now, I'm getting close to expiration and I'm really close to my maximum loss, I'm staying in that because there's almost nothing left to lose. But with the volatility that typically happens towards the end of that week, usually the Fed, or at least when Yellen was in office, they would hold their meetings the one day of monthly options expiration, which would increase the volatility back then. So you have this increase in volatility, minimum risk. You might as well hold on to it. The other concept here, and I feel in investing, this will make or break you, that your example made me think about, is going back to fear and greed when it comes to money and investing. So right after the crash, you know, people are selling, these REITs for, 5 cents or 10 cents on the dollar. It's a panic, right? It's fear-based. I'm going to offload this. There's this, emotion tied to it. And they say, it's not timing the market, it's your time in the market. So what if you held on to that, just like you wrote it down, you wrote it up. But because it was such a sharp decline, there's that fear that's instilled because, someone experienced that. And it causes this impulse in offloading the investment. I see that all the time in stock trading, and I feel, the real estate example you gave is no different.
Yeah, I think and I go back to the Warren Buffett thing again, he has this thing where he says every investment you should look at it and imagine if the stock market's going to be closed for the next 20 years, would you still own it? And I always like that example. I think it's a great mental model to say, should I buy this business? And most people don't. Most people get allured by the quick money. Oh, I'm going to get in and out. I'm going to make 100% and I'm going to be out of it. I'm like, yeah, probably that's not what's going to happen. But in general, like I like his framework because it's looking at it and saying, would I own this for the next 10 years? Now, for Diana, and I made these trades too, like, no, I want to be in for like a week and that's out. Like I'm going to be in for the earnings, then out, and that's it. That's okay, if that's your style. But most people can't tell the difference between trading and investing. Most people think they're investors and they're really traders, or vice versa. And that's really bad for your portfolio performance. You really need to understand your investor psychology. If you're a day trader, if you're a swing trader, if you're earnings trader, whatever, like all the times, that's okay. Like if that's your style, but you shouldn't try to be something you're not. There's only one Warren Buffett for a reason, because people aren't wired like Warren. There are some, but they're not many, right? Most people want action. They want fun out of their portfolio. That's my favorite one. Oh, it needs to be more. They'll never say this, but really what they want is they want it to be more fun. What's going on today? What can I tell my buddies? I made $1,000 in Bitcoin, and like they don't tell you when they lose. That kind of buddy. Anyway, so I think it's important to really, if you're in the alternative space, I love alternatives. I think they're great. I especially like them when people follow the Peter Lynch quote of invest in what you know. Like if you're an expert in medical devices and if you want to invest in like equipment leasing, like medical equipment leasing, I know people that do that and they make great returns because they understand their niche. They understand their audience. They can make good money and they're okay with that. And they know what the risks are. I wouldn't do that. I know nothing about medical equipment other than I don't want to invest in it. But other than that, I know nothing about it. Maybe it's a good deal, maybe it's not. But a lot of people do it and make good money at it, and that's great. So I think that's kind of my final thought is invest in what you know. But I know we're kind of running out of time, Diana. We started a little late here. What are some final thoughts you can leave our listeners with? Maybe some practical takeaways, and then where can people find more about you?
Absolutely. So first of all, I absolutely agree with invest in with what you know. I think Amir was a great example of that and really of how you can have that non-traditional background, I'll call it, and then with an entrepreneurial mindset, kind of an appetite for risk and the discipline to really do the research around it, create something that's profitable in a completely different area. There's actually a TED talk called they talk about multi-potentialites. And so I think Amir was a great example of that, where he has these interests in these, different dimensions, like really within finance and then also in the medical field. And he's able to leverage both to be very successful. So those will be my final thoughts in the interview. And for those who want to get in touch, I'm Diana Perkins. I'm founder of Trading with Diana, and you can find us on our website, tradingwithdiana.com.
Awesome. Well, once again, Diana, thanks for joining us on our panel, and we'll definitely have you back on in the future. This has been fun.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead. And remember, no one will care about your money like you do. So invest in your life.